Greetings! The history and current status of the European Union is one of my favorite topics. Previously, I talked about how this community was created, but I'm also interested in how the EU can function in its current form and whether it can stay relevant in a changing world. This is a politically charged subject, but to understand why Europe is losing significance, following the news is not enough. We have to look at previous decisions and the underlying reasons for those decisions. The creation and implementation of the euro, the common currency, is one of those important decisions. In speeches and official statements, the calls for European cooperation and solidarity are always key elements. We also hear a lot about the perceived enemies of the EU, most recently Poland and Hungary, but not long ago, during the euro crisis, the lazy Greeks were the problem, along with most of the southern member states, although for different reasons. European media informed us that while southerners were easygoing and careless, northern countries were hardworking, focusing on saving, allowing their ungrateful neighbors to enjoy the good life at their expense. Things have changed since then, but it's very likely that the same issue will come back, because the actual cause is still with us. The EU itself was formed in 1993 with the Maastricht Treaty, but the intention to create a monetary union goes back to the 1960s. Back then, the deadline was 1980, but first the European Monetary System, EMS, was created in 1979 to link national currencies to each other and prevent large fluctuations in their relative values. In 1990, the new European Monetary Union, EMU, was set up, along with a three-stage process to create a single European currency issued by the European Central Bank, ECB, which was basically the German Bundesbank. Germany had considered the creation of a Deutschmark zone with only the Benelux countries and possibly Denmark, but France would only approve German reunification if a new common currency was adopted. This became the euro in 1995. To adopt the euro, a member state is expected to spend 2 years in the EMR2, which means that the budget deficit has to be less than 3% of GDP, while overall debt has to stay below 60% of GDP. These numbers are ridiculously outdated in 2022 due to massive deficit spending. In 1999, the first 11 countries were accepted, while Greece failed the strict criteria and joined 2 years later. Britain, Denmark, and Sweden stayed out, but the euro was virtually launched. The first coins and notes appeared in circulation in early 2002. Right then, the first problems emerged, although these would stay in the shadows until the Great Recession of 2008. This typically European solution was the result of many compromises. The common currency was implemented without a common budget. Basically, very different economies were suddenly deemed almost identical. On paper, they were just as stable and strong as the German economy, simply due to the appearance of a common currency. Credit default swaps, which estimate the risk of default, declined in all these countries, along with interest rates, which made it easier to get a bank loan. For the first time, ordinary people in southern European countries like Greece, Spain, and Portugal were able to take out large loans and improve their businesses or personal lives. These were the good times, thanks to the European economic boom, which relied on a bubble that was developing on the other side of the Atlantic. The monthly interest could be repaid with relative ease. Greek, Spanish, and other citizens enjoyed the low interest rates that they had not seen before. At the same time, significant labor reforms took place in Germany. The Hartz concept implemented changes in the labor market, creating new types of employment, supporting vocational education, while keeping unemployment benefits at a lower level. This made it easier to create new jobs, but also limited the growth of domestic savings, which was bad news to German banks that relied on these savings. They needed more clients, but they couldn't find any within Germany. Luckily, the introduction of the euro made it easy to provide cheap loans to Greek, Spanish, Portuguese, and other citizens, who were now using the same currency and the same interest rates. Naturally, German, Austrian, Dutch, and French banks started opening up new branches in these countries and provided cheap credit that promised a new era of unprecedented growth and prosperity. The trouble was that a large portion of these loans were not used to improve the southern economies. Instead, ordinary people who had never had this chance before started buying homes, German cars, appliances, etc. And who could blame them? They saw an opportunity and they ran with it without thinking about the possible consequences. The banks were happy as well. They could expand their business and increase their profit even if they didn't enjoy the same growth rate at home. This process continued until the bubble popped in the USA, and then all hell broke loose. Before I talk about that, I should mention that Slovenia joined the Eurozone in 2007, followed by Cyprus and Malta a year later, just before the crisis. Slovakia joined in 2009, while the three Baltic countries entered in the next 5 years. When the crisis began in late 2008, we suddenly realized that the Greek or the Portuguese economy was not as sound as the German behemoth. Government debt ballooned, unemployment shot up, and the people who lost their jobs in these countries could no longer afford the monthly payments. Since they didn't have sufficient savings and job opportunities were few, many of them had to get rid of the nice cars and houses that only those cheap loans allowed them to own. To be honest, they should have never had access to such cheap loans, but European bank executives and politicians proved to be just as imprudent as their American counterparts, with serious consequences that I will describe now. The existence of the euro made things much worse. Although all economies were declared strong and stable, in reality, the exchange rate of the common currency benefited the strongest countries, mainly Germany. The euro was simply too cheap for Germany, which meant it could export more products at a relatively lower price, further enhancing its own position. But for the weaker southern economies, the euro was too strong, which limited their ability to export their own, less competitive products. As it turns out, an economy built on the export of olives cannot compete with one that is built on the export of luxury cars. Normally, when a less competitive country runs into trouble, it simply devalues its domestic currency, making its products cheaper, boosting exports, slowly enhancing competitiveness, which eventually fixes the problem. In this case, since the euro was controlled by the ECB, Greece could not devalue its currency. Instead, it had to follow instructions from Brussels and the IMF, cutting wages and pensions, destroying the lives of millions of Greek citizens. With the risk of default, a bailout package was created, officially to save Greece, but in reality to save the German and other banks that were holding Greek government debt. When the bailout money arrived in Greece in 2010, it immediately went back to these banks, leaving Greece in the same financial hole. No wonder further packages were needed. While the media bashed the lazy Greeks and celebrated the thrifty Germans, the problem lay elsewhere. The euro, in its current form, was pushing down the already weak economies, while making the strongest one even stronger. There were two possible solutions. In the first, the euro would be replaced with domestic currencies, at least in the southern countries. In the second, a fiscal union would be created, eventually leading to a common budget and a European United States. As usual, the EU chose neither. They proposed excellent plans to further tighten cooperation and solidarity, but opposing national interests have prevented a real breakthrough. No government would give up its monopoly on taxation and the budget. For now, the current form of monetary union remains. The next step is the banking union, which includes the Eurozone and a few other members like Bulgaria and Croatia. Their banks are supervised by the ECB, although the lack of a European deposit insurance makes this scheme incomplete. It is very likely that the next crisis will place further pressure on these institutions, because wealthier countries will again have to help out their less fortunate neighbors. putting the future of the EU at risk. In the near future, I will upload more videos on the European Union, including the topic of bail-ins, of which many people are still unaware. Thanks for watching, see you in the next video.